Welcome to the podcast, everybody. Thank you for joining me. I wanted to give you an update on the markets. We've been through some volatile times since the last video podcast. And if you're new to the podcast, basically what we do is we go through, show you some charts, some of the major things going on, some of the trends in terms of commodities, stocks, bonds, maybe some things that are standing out. And we're sitting here with about 40 minutes to go until the close. So you'll still see some of the numbers moving and changing. We do have Apple earnings after the bell, which of course can be a bellwether in terms of moving the markets tomorrow. But I did want to show you some things that I'm looking at here. And of course, we had a big, not a big drop, I would say about a 4% drop, which feels really big because the markets haven't had substantial drops in the last 2-3 years. But we did have this Greece-related drop, China-related drop, late June, early July, only to see this thing break the 200-day moving average, snap right back as this market's done time and time again for the last few years. But you can see here, we're kind of at this point where definitely the uptrend, and we've had this uptrend drawn here for a long time, and you can see we broke it in October, market fell about 9.9%. Bounced right back, went right back up to the top, and we've been zigzagging but moving higher. And you can see perhaps we're starting to flatten out a little bit, losing a little bit of steam. What's the next catalyst? Well, certainly we checked off Greece, if you want to call it checking that off, or if it was fixed. I mean, basically loaning them money to pay people back. The loans is what got them into trouble, and now they have more loans. But regardless, the market says, okay, good, we don't have to deal with that. And we certainly dealt with China and the drop there, and I can show you that drop, which, the Shanghai Composite, this big old move we had down here. Look, we had a 100, and this is a 150% move from July of last year until June of this year. So in less than a year, the Chinese stock market went up 150%. And after that, of course, it fell 33%, and now we've seen it bouncing here. And so the bounce isn't a shocker. The question is, does it roll back over or not? This can have an impact on their economy, can have an impact on the global economy, but you combine that with Greece, you combine the fact that commodities themselves are falling, and you've had a really nasty drop in some of these different areas, and we'll get to some of the commodities in just a minute, but kind of getting back to the market. So we checked off, China bounced a little bit. We checked off Greece. What's the next thing? Well, we still have the Fed. We have earnings coming out. Of course, you have companies that are missing on revenues, beating on the bottom line. But we have this from a technical perspective to deal with, which is this, triple top, whatever you want to call it here. Should we be pulling back right now based on the fact that we had this big run? The answer is sure. We should be pulling back a little bit. And let's see over the next few days what happens, but it wouldn't surprise me to see it pull back maybe somewhere in this area and then turn back up and start heading back up again. That's what we saw back here, a little bit bigger move in October, but the market, it is losing a little bit of steam, and I do want to warn you about that because you're seeing some of the stocks that are participating, there's not as many stocks participating as the bottom line. And so even though the indices are reaching near highs, there's not a lot of stocks participating with them, and that's a concern. That's a negative divergence. So what you get is this bigger picture where you're seeing, the under the surface is deteriorating a bit. And of course that can change, but we did see a lot of these things peak in April. A lot of the advanced decline lines, things like that, peaked in April. Even though the market's at the same place, a lot of those are pulling back. So that's something to watch. So watching the S&P here and showing a lot of resilience, but definitely lacking a lot of intensity just yet. So what's the next catalyst? Well, some out there are saying maybe it's politics. Maybe because we get a more moderate Democrat or any Republican, you're going to see perhaps some tax cuts. And could that be a stimulus going forward in the next few months? So we'll see about that. But here's the S&P 500. Of course, if we look at the Dow, which is down 200 today, a big part of that is some of the big large cap names that have disappointed have a heavy weighting. Remember, the Dow Jones is a price weighted index. So if the stock is $100 and something per share and it goes down, it has a bigger impact, whereas the S&P is market cap weighted. If we look at the The dollar, of course, had a big run, and then it rolled over, and everybody said, well, that's the end of that. Well, now you can see here that it's breaking back up to the upside. So stronger dollar means weaker what? Weaker commodities. Well, here's oil, okay? The ETF for oil pushing back to lows or near lows. I think 42 was the low on oil itself. If we switch over to the actual oil, so yeah, we can see it down here. That price that day was a low of $42. So we're still at 50, but kind of languishing again. Had a big 8% down day, but as the dollar goes up, commodities go down. Gold, we read a blog article last night on gold. It just looks like death. I mean, I think in the big picture, if you want to go see a longer-term picture, I think gold is going to go to $1,000 an ounce eventually. I think it's oversold. It'll bounce, but I think ultimately it does go to $1,000 an ounce, and I show the reasons why on the technical pictures. But gold's just ugly, and like I said, you could probably buy some for a trade, but even today they're down. If you look at the gold miners themselves, they were up. You see this long tail. That means they were up more, and then they faded as the day has gone on. So they popped, and then they faded back down, up about 2.6%, but these were down 10% yesterday. And this is, look, if you're value fishing in this market, this is the place to go, is the gold miners, the material stocks. Those are the areas that are just beaten up the most because the dollar's strengthening. Fed's going to try to raise rates at some point. Global economy may be slowing. China, Greece problems. It's not a good combination for all of these. But I would say if you were going to buy something today and stick it on the shelf for the next 5-10 years, it'd probably be the commodities complex. They've just been beaten up. I mean, look at this. This is the Dow Jones Commodity Index ETF. This is a $40 ETF. Let's see, right in here was $40. It's at 27. So you're talking a huge decline. And yeah, this could get worse. But if there's something else going to stick on my shelf for the next few years, this would probably be it. Unfortunately, we try to make money sooner than the next 5 to 10 years. So that's what's happening with that. If you look at treasuries, of course, bonds have had a big sell-off as rates have pulled back or gone back up again. 17% decline for TLT. It's kind of stabilizing in this area. Obviously, the natural place for it to go would be somewhere down closer to 110, and then maybe we'd see a bounce. But that's been another area that's been under pressure. So if you're an investor looking at this market, you're going, okay, stocks, Dow Jones kind of flat for the year. Bonds, if they're treasury bonds, down 6% for the year. Oil, down 5% for the year. Emerging markets are now negative after being positive. The developed markets are actually up on the year 7.5%, so they've done okay. Gold down 7% for the year. Utilities down 7% for the year. The one thing that has done well is technology, and you can see NASDAQ reached a new high yesterday, 5,200 or so, and that's been led by, full disclosure, in our aggressive we own Facebook, but that's been led by Facebook. Facebook has done well. Google has obviously done well after that big gap up. And so we've seen some of these leaders, Netflix doing well. Apple still up there, even though, hasn't had a lot of attention lately. It's still up near its highs. And was, we talked about on Twitter that this area right here looked like a decent spot for at least a support, and it did bounce on that, and that was kind of right when the market turned around and it went up as well. But we'll see after the market close what Apple does. I think the Apple Watch has been a big disappointment, frankly. I think it's too expensive. I think it's a little I think it's not getting that mainstream penetration that they would like. Its price is going to have to come down over time, and maybe it will in the second iteration. But so, is that already priced in the stock? Who knows? It's still a cheap stock. I just like it as a more of a dividend play over the next few years than I do than a growth play. So that's that. And then if you look at volatility index down here on the low end, so we had the pullback in volatility, up a little bit today. Still sitting here with the Dow down about 200. Dow, the worst of the bunch, down about 1.1%. S&P down about 0.5%. So there hasn't been a lot of places to go this year unless you are very, very actively trading. Unless you've stuck with technology and healthcare, the more diversified you've been, the tougher it's been. And perhaps as we move forward, maybe that continues because of the fact that the markets get more narrower and narrower as we move forward because the market's just simply maturing. But let's watch this thing to see if it does break out to new highs here. But this little pause we're going through in the today, and if we go over the next couple days, isn't shocking, even if you're bullish, because look, we had a pretty good move from the bottom to the top, was about 4.5%. Now we're retracing that a little bit, so it wouldn't surprise me to see us pull back a little bit more. But all in all, I don't know what the next catalyst is going to be, other than the fact that there's still not a great place for people to put their money, other than the stock market. Yeah, you can sit in cash, but right now you don't want to put it in gold and things like that. You don't want to put it in bonds. International scares you, so you stick it in the stock market. And then within the stock market, healthcare has done well, technology has done well. So that's kind of what I'm seeing right now. And again, making a few trades here and there, but for the most part, you just got to be patient. I think one thing people do is try to manufacture gains every single day, and sometimes they're just not there. And you got to let your things kind of pause and rest. And a good example is looking at something like a Netflix, which I don't own, unfortunately. But we've had these gap ups, right? And we've talked about that here in our office, that we had these gap ups, right here. Stock gaps up. Well, usually you'd say, well, I'll sell that. Well, and all that happens is the stock moves sideways, maybe down a little bit, moves sideways, gaps up again, moves sideways, goes up again, gaps up, and now it's moving sideways again. So winners are winning in this market. And normally when you take profits and move on to something else and moving into something that's maybe more of a value, it's not working. What's working is sticking with the winners. And that tells you that perhaps the value stocks to some degree are losing their luster and people are giving up on those. So again, I wouldn't make any major moves right now, but getting through earnings season is kind of the next thing to check off the list. And then of course the market's still pricing in a Fed rate hike, which I'm not convinced they're going to do yet. All right. Thank you very much for watching. And if you have any questions, feel free to send them our way, and we'll try to answer them and try to cover some things that maybe you want covered in these video podcasts. I appreciate it, and we'll talk to you soon.